Blog Talk Radio.
Across the country and around the world, streaming live on the internet, it's Real Estate Coaching Radio, bringing you the latest news, interviews, and secrets of the top producers. Hosted by award-winning real estate coaches, Tim and Julie Harris.
All right, Julie, we are back, and welcome everyone. We are broadcasting live here on February 28th.
Live, we promise.
From Austin, Texas. It is a beautiful day. It's going to be 80 today in Austin, Texas, which is really nice. But the winter is finally turning the corner. Now, winter in Texas is not like winter in where we used to live, Ohio, but still,
you're being kind of mean here.
And damp. I know. I started to talk about the temperatures, and I started to feel guilty. That's the reason I tried to redirect myself. Yes, and we're getting news from all of our really hundreds, if not thousands now, of coaching students in California that you guys are fearful that all the rain's going in Southern California, all the rain's going to cause you to slide off into the ocean. Fear not, you won't last long. So use this time where you're spending huddled in your house, listening to Real Estate Coaching Radio to prepare your business plan if you haven't done so yet, and also a great time to get in contact with past clients. Oh, and here's an idea for all of you, regardless of where you are in the country. The last day, that would be today, and the first day, hey, guess what? That's tomorrow, are always the best days to be prospecting expired listings.
It's Expired Palooza once again.
There you go. And it's the Expired Palooza. Yeah, that's right. You have to celebrate the end of the month, celebrate the first day of the month, because in your MLSs there will always be the highest percent or highest number of expireds. Now remember, we warned you the other day, make sure you're not violating the laws on the do not call list, because there's every reason to believe that our industry is going to be very much targeted for agents and brokerages and mortgage people and whatnot that are flagrantly violating the do not call list, which is, let's be honest, a lot of you guys do, and a lot of you are being told to, and a lot of you are frankly being given bad advice that will result in $11,000 fines. Oh, side note, I read actually yesterday night about a brokerage on the East Coast that was fined, I think it was $700,000. I'll have to put that on the blog, Real Estate Insider News. Yeah. So, Julie, you and I have a lot of ground to cover today, so Julie's coaching corner is going to have to wait till Monday unless you have something really compelling to share.
Completely fine. I've got some good stuff I'll save up. All
right, good. So the topic of today's show is arguably one of the most, I think, controversial topics if you're paying attention at all to the real estate industry right now. And we're talking about something that's probably even more controversial than the whole buying buyer leads trend, which I think we have really made clear. I don't want to get on that rant again. It's very easy for me to do that. But the idea of you guys buying buyer leads, if you have not gotten it clear in your head that that really is insane, please go back and listen to past radio shows. Or even better yet, if you want us to explain to you how you should never be buying leads, then just go to freecoachingcallsforagents.com, freecoachingcallsforagents.com. And, hey, guess what? Julie and I have left ourselves in rotation for another 2 weeks, so you guys can literally schedule free coaching calls with us, but our spots fill up, and generally speaking, you have to schedule a week, if not 2 weeks in advance. So go to freecoachingcallsforagents.com, and you can schedule a free coaching call with Julie, myself, or any of our we only have a handful of our coaches up there for now, but we're going to be putting more up there soon. So the question is on everyone's mind, what the heck is going on with the Mortgage Debt Relief Act? Julie, I sent you that link from realestateinsidernews.com. Do you have that in front of you?
Got it. Yep, I do indeed.
And you guys, I've essentially the outline of today's presentation is going to be based on a blog article that I pieced together. It's not going to be winning any Pulitzers, but the content's all there on realestateinsidernews.com. You can go there, read all about what we're going to be talking about today. So the big question is will the Mortgage Debt Relief Act be extended? And the answer that I am absolutely 100% confident in sharing with you is yes, it will be extended. There are currently, by my count, 6 bills in Congress. Different congressmen have proposed the extension of it. And then there's at least, from what I've been told, 1 or 2 Senate committee something or another's. I'm not really up on all the Senate mumbo-jumbo, but the bottom line is the Senate is also considering extending it on their own. My information is coming from the best sources that there possibly could be on this topic from the National Association of Realtors. So they're going to be releasing articles on the extension. They're going to be talking about it, but I'm sharing with you now that I suspect, well, by the way, they had originally planned on getting it extended in January. It was part of another piece of legislation that, you know, how Congress operates. It's no secret that it's not the most efficient organization in D.C. Is that an oxymoron right there, by the way? But in any event, so the point is that they didn't get it extended, and it wasn't because there wasn't support for it. It's because it was part of other political wranglings. So now, like I said, the bill's been essentially reproposed, or different congressmen are championing it. You guys can read about it if you want to hit Google and just put in Mortgage Debt Relief Act extension. You can read that really all the major banks, every sort of political mover and shaker, they're all saying, what the heck, this is insane that we haven't extended this. And most of the pieces of legislation that I've read are proposing to either make it permanent or extend it for at least another 24 months. Wouldn't it be nice if we don't have to talk about this topic for another 2 years? Okay, but in the meantime, what is going to happen is it will get passed. I'm hoping it gets passed before June, and it will be made retroactive. So everyone be clear on that there's every reason to believe that it's going to get extended, and it will be made retroactive. But here's the question that I had. And normally on Fridays, obviously, we cover all your guys' most, I think, pressing questions, and this is one I personally had probably about a dozen times, so I just made that the topic of today's show. What if it isn't extended? So first of all, we're going to break this up into two sections. The first one is I'm going to catch you guys up, and actually Julie is, because she's going to be reading the stuff. She's a better reader than I am, on all the stuff that is actually happening with the current state of the market in terms of underwater owners. Lots of confusing information out there, and it seems even some of the people in our industry are confused about what to believe and what not to believe. So I've spent, as I always do, considerable amounts of time picking through the data points, and frankly, I think I put it in bite-sized pieces for you guys. So, Julie, you have the notes in front of you if you want to just jump right in.
You got it. Shall I start with facts or?
Yeah, start with facts.
Okay, let's start with the facts. According to most recent numbers, so remember, everything on our blog is updated when you're reading it. So recent numbers, nearly 10 million people were underwater on their mortgage in the fourth quarter of 2013, collectively owing $657 billion, with a B, more than their homes are worth. The negative equity rate fell to 19.4% at the end of the fourth quarter from 27.5% at the same time in 2012. 8.3 million homeowners are either slightly underwater or slightly above water, right there on the edge. These homeowners represented 18% of all U.S. homeowners with a mortgage as of the beginning of September. So, Tim, when we do these numbers, it's easy to rattle off millions and billions and how much. 8.3 million homeowners. Think about how many that is. Most of our listeners live in towns between, if you look at the suburb they're in, maybe 5,000 to 25,000 people. They're larger towns, maybe 500,000, right?
Julie, check your chat. Okay, check your chat. So, guys, so here's really to summarize what Julie just said, and I want to make this really clear. First of all, before we jump back in the stats.
My point is there's plenty. But go ahead.
Before we jump back in the stats, and Julie will pick up there, I just sent her in chat, in case you guys were curious, some updated stats I just found when I was doing some homework. So the California exception, the Internal Revenue Service, IRS, recognized that the debt written off in short sale does not constitute recourse debt under California law, and thus it does not create so-called cancellation of debt income for underwater home sellers for federal tax purposes. I'm telling you this because if you are in California, you are, frankly, again, we want you to always seek the advice of an accountant, a CPA, a tax attorney, and whatnot, and make sure that you are not giving tax or accounting advice to any of your clients. It's absolutely, and guys, if you don't get this by now, you better sure as heck be telling your real estate sellers, the underwater owners, to seek professional advice. But this is the overview. You can give them this information and then always say, now go talk to an accountant. All right, so again, following the IRS's clarification, the California Association of Realtors sought a similar ruling by the California Franchise Tax Board. Now the Franchise Tax Board's clarification, underwater home sellers also are assured that they are not subject to state income tax liability, resulting in tens of thousands of distressed home sellers from California tax liability for debt written off by lenders in short sales. Okay, so what does that mean? That in California, you are basically not going to have to be stuck with any sort of regardless of whether the Mortgage Debt Relief Act is extended or not, in California, you will not be getting a tax bill. And I know a lot of you, thousands of you who are in our coaching programs, are in California. California is our biggest state by a country mile. And as a result of that, you guys need to be clear on that. And again, I'm going to say this for the fourth time, I think. You absolutely positively have to be seeking the advice of an accountant, a CPA, a tax attorney. Go to the IRS's website yourself and inform your clients to do the same thing. Don't be in a position where you're giving advice that's outside of the realm of your real estate license, unless, of course, as some of you are an accountant, a CPA, or a tax attorney, okay?
That's true. I do have two personal clients that are accountants for real, and that's different.
Yeah,
and,
exactly. So then you're qualified.
And the conversation about don't call yourself a, quote, expert, because that's a legal term. You can still do your job as a professional real estate advisor, but you're going to be smart and advise them, as Tim said, to talk to an attorney or an accountant. Part of that reason is, just like all real estate transactions, all of their financial situations are different. And, that kind of gets you out of those conversations anyway. Your job is to get the house sold. But back to you, Tim. Okay,
so now in the second part of today's call, guys, we're going to be getting to the specific facts with regards to what happens if the Mortgage Debt Relief Act isn't extended. So we're going to be talking about something that, frankly, all of you should know about, but again, just make sure you're giving your owners an overview of the facts and not playing accountant, not playing CPA, and things of that nature. So, guys, we will get to those facts in just a second.
Is coaching right for you? And how can I guarantee it will work for me? Chances are you are asking yourself those questions right now. I'll answer those critical questions for you in just a moment. But first, let's be honest about something you may have always suspected. You've probably always known that the nation's top 1% of realtors, those millionaire agents you see on TV, they possess a secret knowledge that the other 99% of agents do not have. Where did they learn what they know? And more importantly, how did they learn how to put this closely guarded information into money-making action? It's simple. They have a coach. Not just any coach. The nation's mega millions, top 1% of the realtors know that in order to maintain their almost unfair advantage, that they must have their own personal coach. A proven, market-tested coach who has truly walked in their shoes, a coach who has worked with many of the nation's leading agents. At this point, you're probably ready to maybe try coaching. However, you don't want to be unfairly locked into a long-term ball and chain that coaching contracts can give you. It just makes sense that you should be able to try it before you buy it. Even more importantly, you want to have a coach who is the best of the best. Not someone who is simply assigned to you, or even worse, has never sold real estate. Can you imagine? If this is you, I have something for you right now that is exactly what you have been looking for. For the next 48 hours, Tim and Julie Harris Real Estate Coaching is offering you a free coaching call. This is a real coaching call with a real Tim and Julie Harris coach. Now, while you are thinking about it, why don't you visit us online at freecoachingcallsforagents.com to get started. Once again, that is freecoachingcallsforagents.com. Now, let's be clear. This exclusive coaching opportunity is only available for the first 50 realtors who are stone cold serious about their real estate business and know that in order to succeed at the highest level, they must hire a coach. So don't wait any longer. Take action now and visit us again at freecoachingcallsforagents.com to schedule your free coaching call. Again, that's freecoachingcallsforagents.com. Thanks so much. See y'all soon.
Okay, so I'm going to pick right up where Julie left off. 8.3 million homeowners are either slightly underwater or slightly above water. So let's just term those for today's radio show as near underwater. These homeowners represent 18% of all U.S. homeowners with a mortgage as the beginning of September. Now, the reason that I put that in the blog article, and you guys can read that on your own, is because it's important that you understand that the news articles that will be coming out over this weekend that are talking about the fact that there's like 3.4 million fewer people underwater, There is a big difference between not being underwater and having enough equity to sell, let alone having enough equity to purchase your next home. Now, I'm going to say that again because it's really critical that you understand that. So let's say somebody in, Columbus, Ohio, or Omaha, Nebraska, they have been underwater by, $50,000, and over the past 7 years, let's say their home equity has recovered to the point where they're par with the mortgage. What they owe is what the house is worth. That doesn't mean they can sell unless they're willing to write a check, because as you guys know, let's just say 10%, it costs 10% to sell a house between the realtor commissions and the taxes and all the whatever local, conveyance fees and all the rest of it. So it's going to be 10%. So that means that unless the person has the ability to write a check for 10% of the sales price, they can't sell. But let's say that they do. Now, the secondary problem is if they wanted to purchase another house, they're going to have to then come up with that cash again someplace else. So, sure, it is definitely good that a little over 3 million people, as a result of the last 12 months, are no longer underwater in their houses. That still doesn't take into account the 10 million, 9.3 million, that are what are termed deeply underwater. They still exist. But then you factor in the people that are near underwater, then the number, again, is close to 20%. So the reality of it is that it grabs the headline saying fewer people underwater. But you guys know as well as I know that when you go out and talk to a seller and you do a net sheet for them and you show them, hey, you're not underwater anymore, that's only really maybe a third of the battle. The next leg is how are you going to pay your selling fees? And by the way, if you want to purchase something else, hopefully you've got some money under your mattress, otherwise it ain't going to happen. So keep those things in mind. And you guys got to be thinking with your heads when you hear little tidbits of information starting to come out. Think with your business person mind and, make sure your real estate cap is screwed on straight so that you can be dissecting that information before you just start blindly believing it. So we're giving you the facts. Again, we're the only real estate agent-centric coaching company that there is. Our primary focus is giving you the information, put you into action, and hopefully it'll get you down the road. So, Julie, what's the next point?
All right. So, again, just to make sure that they're totally clear on this, at nearly 40%, you're talking about the effective negative equity rate if we put everyone who's on the edge and everyone who's for sure upside down. Borrowers who have less than 20% equity, that's still increasing. So to buy a new house, as you said, most homeowners probably need 20% equity. So moving on to how many we're talking about, well, what does that cause for people? More than 126,000 properties in the foreclosure process nationwide had a loan-to-value of 100% or lower in September, which represents 24% of homes in the foreclosure process. States with highest percentage of foreclosures with equity, so keep in mind, not all foreclosures are, the traditional type. Some of these have real equity. That includes Oklahoma at 54%, Hawaii 51%, New York 47%, and Texas at 46%. States with the highest percentage of, now we're talking about deeply underwater homes or a loan-to-value of 125% or higher, meaning they owe at least 25% more than the house is worth, included Nevada, Illinois, Florida, Michigan, Rhode Island, and Ohio. So nationwide, 7.4 million homeowners with a mortgage had 50% equity or more, representing 16% of homeowners with a mortgage. Metro markets with highest percentage of homeowners with at least 50% equity included Honolulu, San Jose, Poughkeepsie, New York, Pittsburgh, San Francisco, and New York. So does the extension of the mortgage debt relief actually matter?
Does it? That's the question. So, Julie, what I want to do is just making sure we can cover as much ground as possible on today's show.
You got it.
We're not going to do a review of the Mortgage Debt Relief Act and blah, blah, blah. You guys know that we believe it was it was temporary expired, let's call it that, and hopefully it will be renewed any month now. And when it does, it's our firm belief that it will be made retroactive. But this is to answer the question, what happens if some black swan event happens in the political arena and it isn't extended? So let's talk about the fact that maybe the extension of the Mortgage Debt Relief Act for probably 99% of all the owners you ever deal with really doesn't matter. And, again, this is going into the realm of the accounting legal advice that really we're only giving you the cursory information, and we are not giving you legal or accounting advice, and it is your absolute imperative that you educate yourself by speaking to licensed professionals, and that you also speak to or advise your coaching clients. Listen to me, your real estate clients to do the exact same thing. So that is about as many disclaimers as I care to give in one radio show. So Julie, let's jump right in. Okay, so the fact is mortgage debt that is forgiven by a lender is normally considered taxable income without the Mortgage Debt Relief Act. But the IRS is offering a way for people to avoid being taxed on forgiven mortgage debts. So Joel's right where it says IRS insolvency clause. Yep. Could you read the next paragraph, please?
Sure. You got it. So again, IRS, it's called the insolvency clause. Homeowners that are facing a short sale or foreclosure and are worried about having to pay taxes on their forgiven debts may not be aware that they could qualify for tax relief through the IRS's insolvency clause. Now, this is independent of the Mortgage Debt Relief Act. This has been around always, practically. With this clause, a seller is exempt from paying taxes on a forgiven debt to the extent that they are insolvent. What this means is that the amount of a seller's debts and liabilities is greater than their assets. So that's insolvency for you, right? The amount of the seller's debts and liabilities is greater than their assets by more than the portion of the debt forgiven. They are exempt from paying taxes on the forgiven debt. That's pretty major.
There's an example that's coming up that, yes. And by the way, guys, I found the backings of all this on the IRS's website, so you guys can get this information yourself.
Yeah, pretty easy to find. Yeah, so and a smart agent would print it off and know what they're talking about. Yes.
In the time remaining, we're going to go over the example, the insolvency clause example. So go ahead, Jules.
All right, perfect. And again, all this is at realestateinsidernews.com. So for this example, a homeowner has a house worth $200,000, but a mortgage debt of $350,000. The owner short sells the home for $200,000, which is what it's worth, and the bank forgives the remaining debt of $150,000. This forgiven debt is initially treated as, quote, taxable income by the IRS. Now, the principles of the insolvency clause can be applied. First, add up all the debts and liabilities as well as your assets. The IRS expects you to list the mortgage debt as a liability and the fair market value of the house asset. If your total assets amount to $500,000 and your liabilities are $650,000, you have a $150,000 insolvency. So in this scenario, the insolvency amount of $150,000 matches the forgiven mortgage debt of $150,000, which makes the homeowner exempt from paying taxes on the forgiven debt. Every dollar of the forgiven debt is protected up to the insolvency amount. So if the insolvency in this scenario is $100,000, the homeowner would still pay income tax on the remaining $50,000 of the forgiven debt. But I don't know about you, Tim, but if I think back to most of our real estate clients, trying to prove insolvency really wouldn't be too much of a challenge. Most people have more debt than assets, especially after the recession.
So again, it's really critical that you guys understand how this works. And again, the fact is if someone's debts are greater than the amount that's being forgiven, their liabilities, and this is the case for most people. You can talk about credit card debt, car loans. You're talking about student loans maybe. You're talking about who knows what else they might still owe money on.
It's any kind of debt, correct? Not just house debt.
Right. It's any kind of debt. But, Julie, I'm not even sure I think it might actually include debt from other mortgages. So if you have a rental property that you're not short selling, so
it is
any kind of debt. Right. Now, this is a process that you have to send your clients through to talk with their CPA. But for the most part, everybody's going to qualify for essentially being insolvent in the United States. It's a sad but true fact. And then they won't owe any mortgage debt. Now, there's your answer to your question, as many of you have had. What happens if it's not extended? In many cases, for many of your sellers, if it's not extended, and most likely in almost every example, they won't have any debt. They won't be liable for anything. Those of you who are in California, again, we're not accountants, we're not CPAs. That's disclaimer number 6. They aren't going to be on the hook anyway. Now there are caveats to it, types of properties, types of mortgages, but again, for the most part, even if the Mortgage Debt Relief Act isn't extended, which again we know it will be, but even if it isn't, most of your owners won't be suffering any consequences in terms of debt. Now, it is critical that you remember that when you're negotiating your short sale, and if you don't know how to do this, please don't even bother listing short sales, but you put something in there where the lender agrees not to pursue a deficiency judgment. We weren't talking about deficiency judgments today, were we? No, we were not. We were talking about the debt that is part of the Mortgage Debt Relief Act. We're talking about essentially what's going to happen if for some crazy black swan reason it isn't extended, again, which we think it will be. We're confident that it will be. But, again, you're looking here at two different scenarios. You have your Mortgage Debt Relief Act, taxes that are due, and then you have your whole thing with deficiency judgments that when you're negotiating a short sale, that you correctly have essentially include into the negotiation that the lender is agreeing not to pursue a deficiency judgment. If you don't get that in writing from the lender, you can pretty much assume that down the road, that seller is going to be getting a nasty little call from a collections agent asking for the money that was forgiven on that loan. And you are then going to get a nasty little call from your seller asking why the heck you didn't advise them to get that removed from the loan, get that removed from the final negotiation. This all goes back to the fact that you guys have to be very careful, and if you don't know what the heck you're doing, consider enrolling in our accredited short sale designation program and to get that education. Those of you who were enrolled a while ago, as I know thousands and thousands of you were, it's probably time that you brush off that education. The ASD program, we're not going to increase the price. It's been $97 for the last 7 years, and we're going to keep it at $97. So if you need to brush up on your short sale knowledge, definitely re-enroll in that program. It's probably and always will be one of my favorite programs because, frankly, I know it's a program that we developed before all the other short sale education trainers and whatnot, and I think we really set the stage for helping, hopefully, millions of people figure out a graceful exit from their underwater mortgages. So, Julie, this is a boring topic for people that are not actually active in the business, right? I mean, if you're not trying to be a listing agent, if you're just a buyer's agent,
well, then you might not have to deal with it.
Yeah, this probably wasn't that interesting to you. But if you are going to be active in any market, it's funny, some of the hottest markets for the real estate recovery, as Julie read the list, your Manhattans where people are always talking about how expensive everything is. Most of California, this is the thing I say, it boggles the mind, right? Nearly 30% year-over-year appreciation, quote-unquote, in Las Vegas, Nevada, and yet Las Vegas, Nevada has the highest percent of people that are still deeply underwater on their mortgages. How can both of those things exist?
Just because it's, quote, recovering doesn't mean it's recovered,
Right.
I mean, when you have a bad cold and you're feeling better the first day, that doesn't mean you're ready to run a marathon.
It's interesting, Julie. One of the things that I don't think a lot of people expected was that underwater owners would just keep their houses. I mean, that's the little thing that doesn't really figure in. So we're reading all these statistics about these, arguably close to 20 million people that are still underwater or near underwater on their mortgages. They really can't sell unless they're going to either write a check or, do a short sale or lose it to foreclosure. But that doesn't mean they have to sell. So there's a lot of, where am I going to get short sale leads? How do I go about getting leads? I think it's, guys, get clear in your head. In every state in the nation, there is a process that when someone misses a mortgage payment, there is going to be a list that is published where you can get access to that list and solicit those people for their short sales. Offer your services, letting them know what you can do to help them avoid foreclosure. There is no magic secret to getting handed short sale leads. There obviously are still services that are doing it. But anymore, just get a list of the pre-foreclosure, it's called list pens, it's called all kinds of different things. But get a list of the pre-foreclosures and solicit them. You can get them from Foreclosure Radar. If you want a discount on that, you got to call our office direct at 866-422-9497, 866-422-9497, and ask Rochelle for the discount code for Foreclosure Radar, and they'll send you all the seller's information, how much they owe on the mortgages, all the information that you need. So when you're calling them, you're fully prepared. But again, there's no shortage of underwater owners, and there's not going to be a shortage of underwater owners anywhere in the country. So, Julie, as I was going through this, we're presenting this. It's kind of technical information, but it's relevant.
Sure.
What were you thinking? Where does your mind go? Because I'm always thinking about how are people translating this,
Yeah, I think that now that the word or the phrase, the topic short sale is not like, oh, what's that? We're well through the woods on that. It's kind of normalized. And I always tell clients, when we're selling, recession or not, upside down, underwater, partially underwater, there's lots of reasons people wind up having to do a short sale. What my mind goes to as a coach is, this is one of those things that as an agent, you don't want to say, oh, no, that's not something I can help you with. Oh, no, I'm going to have to refer you out to somebody, or not even return the calls because somebody mentioned they might be a short sale. you know. So this is one of those things that, not only do you have to know about, but you should be good at, and keep yourself frosty on this. Just like anything else you're doing, first-time buyers, relocation, becoming a great listing agent, this is one of the things that's necessary for great agents who want to make a lot of money. If you're not interested in that, well, just put it in the list of things that you're never going to learn. I don't recommend that. I don't think that's great, but, depends on what you're after, right?
Sorry, Mr. Seller, I can't help you. I don't know how to do that aspect of my job. Very professional.
Yeah, great.
Right? So, guys, one of the easiest ways to get a snapshot of how many people are in pre-foreclosure, which is what you want to be researching in your marketplace, is go to Zillow and then put in your zip code, and then there's a filter section. You'll see there's a little red house and green house. You guys will see it. It's up on the toolbar. I'm not going to do a tech call here for you. But basically go there and remove all of you're going to see, obviously, when you put in your zip code, you're going to see all the little, different colored houses. So remove all the displayed information with the exception of pre-foreclosures, and I'd probably also leave up on there like FSBOs so you can see those as well. And also look for the make me moves. That's a different question, different conversation. But just look at all the pre-foreclosures and then start expanding the area. Maybe put in more than one zip code, and you're going to see a real snapshot of how many people are in pre-foreclosure. Depending on your state, that means they've missed 1, 2, or 3 payments. Not depending on your state, pretty much a national fact, is that once someone misses one payment, there's almost 100% chance they're going to be in default. In other words, they're not going to ever catch the mortgage back up. So when you see someone is on the pre-foreclosure list, that is absolutely positively a house that will be sold because they've already decided not to make the payment, unlike some people that are underwater and still making the payments. Lots of people doing that. So when you see that person that's not making their payment anymore, you know that they are either going to do a short sale or they're going to lose it to foreclosure. The loan mod, a lot of you were having to overcome the loan mod objection for years and years and years. Well, HAPA has expired. The loan mod world is coming to an end. A lot of the people with loan mods are going to fall back into default because their loan mods were for a temporarily lower interest rate, and that interest rate is adjusting now. In addition to that, the negative equity was not removed from the house.
That's just a temporary solution, and we're on the other side of temporary now.
Yeah, the can has been kicked to the end of the road, and you're up against the wall, and you're going to see that a lot of the people that, you did BPOs for, a lot of the people that were doing loan mods, they're going to be on the default list again. So all of that is going to start coming unraveled in your marketplace. Will the improving market, the improving buyer demand, will all that be able to keep pace with the inevitable rise in inventory? Probably. Honestly, I think it will, because I think there's enough pent-up demand out there. But in the meantime, take advantage of the market that you're being offered. You have to, in this market, not just know how to work short sales, not just know how to do BPOs, in many cases REOs, but you're going to have to get back to knowing how to work with normal sellers. You're going to have to dust off your skills. And again, a lot of you need help with that. Request a free coaching call at freecoachingcallsforagents.com. So in the meantime, we are going to wish you a brilliant weekend. And remember, if you need us for anything, the easiest way to get hold of us is just go to freecoachingcallsforagents.com and request your free coaching call. Julie and I are keeping ourselves on that roster for the next 2 weeks. So if you want to schedule a call with us, there's probably still spots. Don't be surprised if you have to schedule a week or two out. If you need to call the office directly, if you're an existing student, you obviously get priority for free coaching calls. Again, freecoachingcallsforagents.com, or just call the office directly, 866-422-9497. Have a brilliant weekend, everyone. Talk with you on Monday.
This program has been a presentation by Tim and Julie Harris, Real Estate Coaching. For more information on our real estate coaching and training programs, visit our website at timandjulieharris.com. Remember to tune in weekdays at noon for upcoming shows. And until next time, thank you for listening to Real Estate Coaching Radio with Tim and Julie Harris.